Look, I read out a load of headlines. Your role is to try and help me look behind the headlines. The focus of the world has been on the yuan. What worries you most? These headlines, which are retrospective, or they literally wholesale throwing everything but the kitchen sink at stabilising the yuan?
Well, I think the weakness in the Chinese economy is ongoing. I think the market is trying to evaluate what the POBC should or can do next to ensure some soft landing or transition, as you call it, for consumers to pick up the Chinese consumers to pick up the slack. I think the market is probably looking for some sort of devaluation down the line. I'm not so sure if it's going to come this quarter or next quarter, but something relatively big has to happen soon, and perhaps help worldwide markets to take this issue behind us.
To put this in perspective, I mean, we have a terminal story this morning saying verbal intervention, rate intervention, reserve requirement coming from the PBOC. We've done a survey, 45 analysts. Rabobank is the most pessimistic. They say a 15% devaluation. My question to you is would the Chinese risk a one-off devaluation event, Guy, given that they've just acceded to the SDR?
I think I mean, in between the lines, one could probably read that they want to do something pretty quickly. But the consequences of something of some magnitude would be such within the Asian context, with a rising dollar and such amount of debt in dollar-denominated paper, we don't know what the unintended consequences will be after such an event. So the 15% mentioned here seems, or could well be one of these numbers that are probably too high to take on.
We've looked at the world markets from the perspective of the equity side, in terms of $7 trillion being wiped off equities. Sovereign bond markets have seen a substantial return so far this year, and British government gilts have actually delivered perhaps one of the most stellar performances. This is the sovereign bond index. World equities down by $7 trillion. Give me your perspective on the world, Guy. We're talking about bear markets. You know, we've made a great deal of news flow this week.
Well, there's clearly a run to safety, and that very much illustrates the state of the world. Investors are on the sideline. There's still be quite a high level of bullishness going into 2016, with of course many headwinds that we all knew about going into the new year. I think what we are seeing is just a readjustment of risk. Investors are just raising cash, waiting on the sideline, perhaps on what's going to come next from China, what the oil price is going to do, what companies are going to be able to do to offset this weakness in the oil price, and what it's going to do to the jobs market. I think there's quite a few headwinds out there, and investors are probably lost patience and wanted to raise a bit of cash, and that's probably why we had such a fall in markets, so rapid.
Your line here is low growth, low inflation benefits higher yielding assets. In that domain, what constitutes a higher yielding value for you?
Well, let's step back and look at the context here. A low growth, low rate environment. I think if you look at the US monetary policy, you see that we're still looking for, or the Fed is still looking for 4 hikes this year. The market is probably already pricing just one, and perhaps some bond investors out there are probably looking for perhaps a return to quantitative easing by the second half of this year in the US. So I think there's quite a wide range of thoughts, of opinions out there. But the one line of thought that I think will continue to be relatively successful within this is to look for companies that are well covered, in terms of capital, and can continue to honor their dividend policies.